In today's video, we are going to talk about why the First Republic banking crisis is just getting started and its reasons. So, let's talk about the crisis happening in the US banking sector. Lately, regional banks in America have been facing big losses, which has made investors worried and raised concerns about the stability of the banking system. This crisis has caused the stock prices of these banks to drop equals. The Federal Reserve, which is the US central bank, is partly responsible for this crisis. They raised the interest rates recently, and this affected the value of government bonds and the bank's assets in a negative way. People are questioning the credibility of the Fed, and experts are urging them to take more actions to fix the crisis. To understand the crisis fully, we need to look at what caused it and what effects it has. It's not just about one bank having problems. It's about bigger issues in the banking industry, which is very important for the United States. In this discussion, we will explore the reasons behind the crisis, how it affects individuals and businesses, and possible ways to solve it. By understanding the details of the crisis, we can make smart choices and navigate through these uncertain times with confidence. But before we dive into the details, do us a favor by subscribing to this channel and share this video with your friends also. Our next story focuses on the spreading crisis in the US banking sector. Yesterday, regional banks in America experienced further losses, with their stocks plunging by more than 10%. This has led to investors pulling out their money, fearing that more banks are on the verge of collapse. Two mid-sized banks, PacWest and Western Alliance, are currently in trouble and exploring their options, including a potential sale. PacWest is particularly in a dire situation, with its shares dropping by more than 50% yesterday. This signifies a clear red flag, as the bank has already lost over 85% of its stock value this year, resulting in substantial losses for investors. This crisis reveals a common problem faced by troubled banks: liquidity issues. There is a severe cash crunch, and these banks are struggling to access funds. The U.S. central bank, known as the Federal Reserve, shares the blame. The Fed's recent interest rate hikes have adversely affected the value of government. Despite the worsening situation, as the Fed's credibility is questioned, some executives and analysts on Wall Street are urging the central bank to take further steps to address the crisis. The current situation raises the question of whether we are dealing with a problem specific to First Republic or a more widespread banking issue. It would be an oversimplification to dismiss this as solely limited to First Republic. Upon closer examination, it becomes clear that this crisis should never have occurred, considering the extensive regulations and capitalization in the banking industry, which holds great importance for the United States. The regional banks heavily rely on the FDIC and the Federal Home Loan Bank for additional cash, and we remain uncertain about their operations once these programs expire. Will this crisis remain contained or extend to the broader economy, resulting in a credit crunch? Its containment relies on continuous progress towards a resolution. Those in the lower quintiles of earners in the U.S. are particularly impacted, as evidenced by Chase data revealing depleted deposit balances caused by the higher cost of groceries required for basic living expenses. Meanwhile, businesses facing the renewal of their floating rate funding are encountering interest rates double or triple what they initially expected. It is essential to acknowledge three critical points that have not received sufficient attention. Firstly, concerns about the return of capital when withdrawing funds from a regulated financial institution and placing them elsewhere. Secondly, the issue of return on capital when transitioning from a bank to a money market fund, where returns are minimal at 0.3%. Lastly, we must recognize the extent of the current pain in the United States, with individuals and businesses burning through money due to the exorbitant costs of goods and services. This is evident from both Chase data and Federal Reserve Board data, which indicate that the bottom quintile of earners is disproportionately affected by the high cost of living. However, it is crucial to note that an increase in credit card usage does not indicate excessive consumption, but rather an attempt to service existing debt. Businesses are feeling the pressure of the new floating rate debt, leading to a cash burn and heightened financial strain. The major financial crisis in the United States prompted numerous inquiries from friends, family, and acquaintances seeking an explanation. To address these questions, I recorded a video to share with everyone, providing a comprehensive understanding of the ongoing crisis. In January 2020, COVID-19 emerged, initially leaving the U.S. economy robust with low unemployment and inflation below 2%. However, as COVID-19 spread and lockdowns were imposed, the velocity of money abruptly halted. To intervene, the government and central bank conducted an unprecedented monetary experiment, injecting trillions of dollars through monetary and fiscal policies. Interest rates were artificially reduced to 0%, stimulus checks were distributed, and bailouts were provided to industries. Despite debates about potential consequences, inflation gradually increased in 2021, surpassing 5% and eventually peaking at 9% in less than 2 years. The Fed insisted that inflation was transitory, but it persisted, eroding the savings of those holding cash and exacerbating the divide between the wealthy and less affluent. In late 2021, the Fed attempted to tighten monetary policy through interest rate hikes and quantitative tightening, but inflation remained at 6%. Simultaneously, banks faced challenges as deposits surged, leading them to invest in U.S. Treasuries and mortgage-backed securities. Unexpected interest rate hikes caused losses on long-duration bonds, compounding the financial crisis. The complex crisis, characterized by soaring inflation, socioeconomic divisions, and banking challenges, continues to impact the economy, emphasizing the importance of understanding its causes and effects. In today's complex and uncertain times, we are bombarded with various narratives regarding the financial crisis and its implications. Some narratives align with each other, while others compete for attention. These narratives come from different sources, including central banks, Wall Street hedge funds, and TV pundits. It is crucial to be discerning about who we listen to, as the messenger can sometimes be more important than the message itself. To navigate through the noise and find valuable insights, we must be aware of all arguments, regardless of whether we agree or disagree with them. These times call for constant evaluation and a willingness to change our perspectives based on new information. It's important not to become married to a single narrative and miss out on recognizing when the world is shifting. The current period is one of immense change and uncertainty. Recent events, such as significant banking failures, indicate that a major financial crisis is underway. The Federal Reserve is facing an impossible dilemma, with potential cracks in the financial system if they continue quantitative tightening or a rise in inflation if they revert to loose monetary policies. While it's challenging to provide specific advice, it is crucial to stay informed, learn, and prepare for various future scenarios. These times demand our attention, and being educated and self-reliant is essential. As we move forward, it's natural to question what actions to take and seek alternatives in the face of the current situation. While I cannot provide financial advice, I can share how others are responding. In the traditional financial world, some ignore the crisis while others invest in high-risk assets, believing they will rise due to loose monetary policy. There are also those who prefer to invest in gold or foreign currencies as a hedge. Each approach has its merits, and individuals must decide what works for their own strategy and portfolio. However, it's essential to understand the financial system, analyze different arguments, and think critically. We're living in complex and uncertain times, and being aware of various viewpoints allows us to check our own thesis and adapt to new information. The intelligence lies in changing our minds when necessary. A major financial crisis is underway, and it's crucial to stay informed, be prepared, and cultivate self-reliance in these times of change. Thank you for joining me in these insightful conversations about the banking industry. We've explored the complexities and challenges it faces, from monetary policy and inflation to financial crisis and the role of central banks. As we conclude, it is crucial to recognize that the banking sector plays a vital role in our global economy. Its stability and proper functioning are essential for economic growth and prosperity. However, we must remain vigilant and informed, especially during uncertain times. By understanding the intricacies of the financial system and staying aware of emerging trends, we can make informed decisions to safeguard our financial well-being. Whether it's diversifying our portfolios, seeking alternative investments, or adapting our strategies, staying proactive is key. Remember, education and self-reliance are fundamental in today's dynamic financial landscape. Seek knowledge, question narratives, and continuously adapt your approach. By doing so, you empower yourself to navigate the ever-changing world of banking and finance confidently. Thank you for being a part of this video, and I look forward to exploring more fascinating topics with you in the future. Stay curious, stay informed, and keep seeking truth.